Today, I'm going to dive into all things development finance and more specifically, the 7 questions people always seem to have about it, but often feel a little bit nervous to ask. So whether you're looking to take out development finance for the first time, or maybe you've done it before, but things didn't go quite as planned, stick with me. By the end of this video, you'll have a clearer picture of how it works and what to watch out for. Because property, it's all about patience and getting those details right. In this video, I'm going to break it down in this order. So I'm going to start with bridging finance versus development finance, then move on to loan to gross development value, then on to stage payments, then on to documentation, then experience, then on to costs, and finally, why you can't just use a regular mortgage. Let's get into it. Bridging finance versus development finance. And this is probably the first question that I get asked. So what is the big difference between a bridging loan and development finance? So both are short-term finance tools, but a big difference is in what they actually cover. So bridge is mainly for acquisition. Let's say you're buying a property at 100,000. The lender might give you a bridge of say 75,000. Simply put, you brought that property okay. And development finance goes a little bit further. It still gives you part of the purchase, but it also funds the cost of the work. And that might be, let's say, a heavy refurb, a flip, or even a ground up build. And in some cases, lenders will even cover 100% of the works as long as the numbers stack up. And this is how I like to think of it. I think of a bridge as buying it, and development finance is buying it and building it. Next up is loan to gross development value, and you see this written as LTGDV, okay? And most people are used to loan to value where the borrowing is at a percentage of today's purchase price. However, development finance is a little bit different, and it's based on gross development value, what the property will be worth once a project is complete. And lenders, okay, will typically fund between 50 and 60% of that GDV. As an example, if your completed project will be worth, let's say, £1 million, you might borrow up to 600,000. And the total of that loan is split into 2 parts. You've got a day one purchase, and this is usually capped at about 70% of the purchase price, and the rest then goes towards the funding of your works. And in some cases, if the deal is strong enough, lenders will cover 100% of the build costs. Stage payments. So how does the money actually get released? Essentially, it happens via drawdowns, okay? At completion, you'll get the funds towards the purchase. Then as the project moves forward, you pay for the first stage of works. A surveyor will visit site, sign off on progress, and then the lender reimburses you. You pay out, you get paid back. You repeat this process, okay, until the project is done. The exact milestones are agreed at the start of that deal when the lender and the surveyor map out the build program. And importantly to note, you only pay interest on the funds once they're drawn, not the entire loan from day one. Let's talk about paperwork. So lenders will want to see 4 key things, okay? Number 1, they'd want to see a development appraisal, so a spreadsheet with all your costs, GDV, and projected profit. Number 2, they'd want to see a property CV showing your track record. Number 3, they'd want to see a schedule of works, ideally from your contractor with the timings and costs. And number 4, they'd want to see an assets and liability statement, so a snapshot of your financial position. So in my experience, good developers have these ready to go, and this speeds everything up. Experience matters, and lenders look at it in 2 ways. So number 1, they'd look at it from a principal developer experience. You've actually been the developer. You bought, managed, built, and exited. And number 2, they'd look at it from a sector experience, so transferable experience. Maybe you've been a contractor, surveyor, architect, or even a broker who's been involved in big projects. And if you're just starting out, your lender options will be narrower and the rates may be a bit higher. But as you build out your track record, your pool of lenders grows and your terms will improve. That's why keeping a proper property CV is so important. Now let's talk about the cost you'll need to budget for. So the big 3 are, number 1, lender's fees, and these usually around 2% of the loan, sometimes with an exit fee. Number 2, you've got your legal fees, and you'll pay for your own and contribute to the lenders. And I'd say always use a commercial solicitor here. And number 3, you've got a valuation, and this isn't your typical kind of mortgage valuation. It's a full detailed report, and yes, it does cost more. And if you're using a broker, I'd say factor in their fee too, and it's usually between 1 and 2%. But in my personal experience, a good broker pays for themselves by structuring the deal correctly and finding the right lender. So why can't you just use a regular mortgage for development projects? So here are the 3 main reasons, okay? Number 1, buy-to-let lenders expect the property to be rented out right away. They don't want you tearing it apart for 6 months. Number 2, substantial works can actually reduce value mid-project, and regular lenders aren't set up to manage that type of risk. And number 3, ground-up builds leave no security for a period of time. So if you knock down a building, a buy-to-let lender effectively has no security. And that's why development finance exists, okay? It's designed for these type of scenarios. I hope that this video has given you clarity and confidence. So feel free to reach out if you need any help finding the right finance for your next development project.